Starbucks Corporation, a global coffeehouse chain, has recently witnessed a downturn in its stock price, currently trading at a 52-week low, down by 15% over the last 12 months. However, it's essential to contextualize this short-term decline within the broader trajectory of the company's performance and its future prospects. Over the past decade, Starbucks has demonstrated robust growth, with its stock soaring by an impressive 160%. Notably, it reached an all-time high of $126 almost 3 years ago, boasting a market capitalization of $100 billion and a forward P/E ratio below 22, indicating a favorable valuation at that time. Financially, Starbucks has exhibited strong year-on-year performance, with top-line revenue growing by over 8% from $26.5 billion in September 2019 to around $36 billion in October 2023. Similarly, the bottom line witnessed a substantial increase of over 20%, with net income rising from $3.6 billion to $4.1 billion during the same period. Moreover, earnings per share experienced a notable uptick of 22%. However, the recent quarter saw a slight miss on both earnings per share, -4%, and revenue, -2%, which could have contributed to the current decline in stock price. Despite this, it's crucial to acknowledge Starbucks' strong financial health, evidenced by an increase in total cash and short-term investments from $2.8 billion to $3.4 billion, albeit accompanied by a doubling of total debt from $11.2 billion to $24.5 billion over the last 5 years. In comparison to competitors like Chipotle Mexican Grill, Starbucks has underperformed over the past year, with a decline of 13.2% in contrast to Chipotle's 32% increase over the past 5 years. However, institutional ownership stands at a significant 72%, with notable buying activity observed over recent quarters. Insider activity, while mixed, does not raise major concerns. Regarding dividend safety and growth, Starbucks maintains a respectable score of 67, indicating a reasonable level of safety. Dividend growth has been robust over the last 5 and 10 years, with a notable 7.5% increase in September last year and a remarkable 177% increase over the last decade. From a valuation perspective, Starbucks appears to be undervalued, with an intrinsic value estimated at $113, while the current price hovers just under $89. The forward P/E ratio is significantly lower than the 5-year average, and according to dividend yield theory, the stock presents undervaluation opportunities. Furthermore, free cash flow has exhibited consistent growth, increasing from $320 million in 2014 to $359 million in 2023. Debt metrics also indicate strength in the balance sheet, with a decreasing net debt/EBITDA ratio over time. Looking ahead, Starbucks guidance for FY 2024 includes revenue growth of 7 to 10% and strong double-digit earnings per share growth. Expansion plans, particularly focusing on increasing store count globally with China as a main driver, signal confidence in future growth prospects. Analyst expectations align with this positive outlook, with Wall Street forecasting an $18 increase over the next 12 months, indicating an upside potential of 22%. In conclusion, while Starbucks currently faces challenges reflected in its stock performance, its long-term growth trajectory, strong financial performance, favorable dividend metrics, undervaluation potential, and promising future outlook suggest that the current downturn may present an attractive buying opportunity for investors. Please go ahead by liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.